Welcome back, everyone. So, in this video, I will be speed running undervalued stocks. And what that means is I will be using a few different websites: Macro Trends, FinViz, SEC, Edgar, and Google. Those will be a little bit more familiar by the end of this video, but they're free websites where you can get financial information. It's pretty accurate, and screeners and all sorts of very helpful things when finding undervalued stocks. The criteria for this speed run is to go through each stock that I find and answer these questions. And if these questions come out to be having good answers, then those will make the stock a possible undervalued stock. And we'll see how many I can get in 1 hour. Let's go through the questions really quickly. So to begin, recognizability, sizable and strong franchise, seasoned business. So is this a big brand? Is it kind of like an Apple or Google or Tesla or Ulta Beauty or all those things? Does it have size and revenue and balance sheet and market cap? Strong franchise in general means, does it have many stores, many chains supported by their customers, and general liking for their product or service? Stability in quarterly and yearly earnings, so that will lead us to the net income on macro trends, and we can see if the earnings will go negative or if they'll fluctuate too widely, and that will be sort of a sign that it's a risky play to invest in, because you want to find stable companies to invest in. And growth in revenue, margins, and net income. While this is not mandatory, it's always a bonus pointer. You can price that into how much you would be willing to pay for the stock if it has a past history of growth in revenue. Margins is just the expenses versus, say, if you had a net margin, it would be the net income versus the revenue. Operating margin would be operating income versus revenue, and those have slightly different meanings, which I can get into as I start evaluating stocks. And net income. Fourth question, can I trust current earnings? Is the industry having an exceptional year? You can't always take the current earnings with complete trust, because sometimes it may not reflect a normal year for them. If they have, let's say, a product that does exceptionally well, or the industry is doing exceptionally well, I could think of AI stocks, and the AI boom having a big impact on current earnings of many tech companies like Apple, Nvidia, and things like that. And it may not be a good idea to use their current earnings because it is an exceptional year of demand. We don't know. It's difficult for something to go from 0 to 100 like that without any plateauing or any balancing of supply and demand. So the next question is, what's the most accurate earnings yield and PE ratio? So building off that, now that we have an idea of what the right earnings are, we can calculate what the PE ratio is. What is the relationship between its normal earnings and its price? The next we can answer is it a capital light company? Does it have a good earned on invested capital, return on invested capital? And what that means is, does it take a lot of money to put into the business to make money? And next question, do margins have room for improvement? Are they lower compared to the industry? Margins are very important to determine how much the company makes on each product or service that they sell. And if they have a history of growth in the past and it's at a point where it's lower than some of the large competitors in their industry, that is a signal that they have more room to grow. And widening margins can be very, very accelerative, or I guess you could say a catalyst for revenue growth and income growth in the future. Shareholder-friendly management, distributing value via dividends, brand growth, and repurchases. So this means how does the management return the cash that they make to you, the investor, or me? And that is a very important question because you can't just rely on the net income and the growth in the company to serve your interests. And you have to make sure that management has your interests in mind. And repurchases, dividends, and brand growth are three main examples of management having the shareholder in mind. Conservative liquid asset values and balance sheet. So, are the liquid asset values and balance sheet values small or large compared to the market cap and price? For instance, there's a lot of different types of liquid asset values that have different ways of calculating and showing the status of a company's balance sheet. That includes cash assets, current asset value, tangible asset value, liquidation value. And the balance sheet values include, property and equipment, current assets minus current liabilities, which is working capital less inventory. I mean, the list goes on. So do those values, are they conservative? And if so, that's a good sign. That means it's cheap, possibly. And finally, is it a business I can understand? This is something that was not mentioned in the security analysis book by Graham and Dodd. However, Warren Buffett has repeatedly talked about the circle of confidence. And what that means is, are you able to understand the business? And if you don't, then you don't have any business analyzing the stock. If you found a company, let's say that's a bank, and it's full of financial derivatives that you can't understand, or it's a very complicated tech company with a bunch of subsidiaries that aren't consolidated, and they all do different things, and you don't have any idea of what the industry is and where it's going. That's an example of a stock that you would avoid, because in order to really analyze a stock correctly, you should be able to understand exactly what you're doing. So, using those questions, keeping those in mind, let's begin. I'm going to start a timer to keep track of time, and I'm first going to, open up the tabs that we're going to be using. Let me do this real quick. Okay. Screen capture. Sorry, it's going to look a little weird for a couple seconds. And one second. Hello. There we go. Sorry about that. A little hiccup. I'm gonna move to the bottom. And delete this. And I'm going to resize this. There we go. Okay. Sorry about that delay. I'm going to start the timer now. 3, 2, 1. 1 hour begins. Okay. So, starting with the FinViz screener, you want to get some of the configured settings up here to begin. I'm going to choose any country. We're going to do some foreign investing potentially. I'm going to do companies that are only over $2 billion in market cap. That'll give me companies with good standing, good size. That's what I'm looking for stability purposes. Fundamental, you're going to want to set some of these values to limiting the PE ratios that you'll get, just to filter out some of the super overpriced securities. So I'm going to go under 20. That's a recommendation made by the mentors of Warren Buffett, Graham and Dodd, in the book Security Analysis. And let's see. Current volume, I'm going to go over 500,000 because I want a relatively active stock. Or no, sorry, average volume over 500,000. And I'm going to go over 2 billion. That's what I want to do. 500 total. Okay. So there are 500 stocks to go through. And we're going to go through as many as we can today. I'm going to sort by market cap. And these are the companies we have to choose from. 25 pages. Okay. I'm going to go over here. Macro trends. This is where I'll type in the stocks. I'm going to have Google Calculator on hand. Nice. All right. Berkshire Hathaway first. Type in the name, brk.b. Financials. I'm going to look at the quarterly net income. Is it stable is the first question. See a lot of deficits, relatively stable. I mean, it kind of hovers around the $30 billion mark. I'm going to check out the yearly net income. Excuse all the loading in the ads. This is a very ad-saturated website. Berkshire Hathaway, major loss in 2022, 4.3 billion. All right, so keeping those in mind, I'm going to create a PE ratio. You know, it's definitely a little bit unstable, so I'm going to lower the PE ratio a little bit. The average quarterly is around 20. It's very up and down. I'm going to go back to the annual. Okay. I'm going to say an average is more about like 50 billion. I mean, these big falls are kind of substantial. This is 43. I'll round it up to 60. So the number of shares outstanding are 2.1 billion. It's 2.2. 60 over 2.2 is 27. BRK.B stock. 27 out of the stock price, which is 448. 6%. Nothing to write home about. Has very good management, but 6% may not be a sufficient enough price to justify the drops in earnings that they've experienced. All right, next, JPM. JP Morgan. I already know where this is going. Looked at this a few times now. So the problem is that they've had a very exceptional year because of the interest rates. So if you actually look at the average normal earnings that they have, I mean, look at that. That's a big spike. It's at 450. This is about 40. Say average earnings is 40. And there's 2.9 billion shares outstanding. This is earnings per share value. $13.8 dollars per share earned. 214 per share. 6.4% earnings yield undervalued again. You can think of that as buying a bond paying 6.4%. It's a little bit more undervalued than Berkshire Hathaway, but I'm looking for a margin that's at least 7-8% because we have such high interest rates right now. I mean, I'd be better off buying a T-bill at this point. All right, ExxonMobil. These are pretty big companies, so I'm not expecting them to be too undervalued, but they are the most safe at least in theory. Yeah, so this is a lot more stable in quarterly earnings. I'll give them that. This is conservatively say 7.5 quarterly times 4 is 30 billion yearly. Is that around what they say? Yeah, okay. What is their earned shares outstanding? Shares outstanding is 4.1 billion. We're looking at 7.3 earnings per share. 114 over 7.3. 15 PE ratio. 7.3 over 114. Again, 6.4%. I'm looking for something a little bit better than that. All right, we're gonna look at the next one, Novartis. Net income, 14 billion. Relatively stable earnings, 2.3 to, I'll give them a 2 billion normal earnings. That's 8 billion yearly. Shares outstanding, 2.1. It's 3.8 earnings per share. 3.8 over 117. 3.2%. It is not justified, especially since it's a foreign company. You want to be a little bit safer. Shell. Yeah, foreign companies, they're definitely something you can invest in, but you should look for ones that are a little bit more stable. Not the most stable earnings. Means I have to derive earnings from the average earnings, I should say. I'm gonna lower it because of these big deficit years from this level, which is about 30 billion. I'm gonna say it's more like 20 to 25. If it's a good margin of safety, 20 should show something promising. $3.4. Shell stock. Whoops. Shell stock divided by 71. Earnings yield of 8.3%. That's pretty good. 8.3%. All right, I'm gonna put that into our list of possibilities. I already have a few. Oh no, I don't. Never mind. I have a few in a different list. This is my ongoing list that I still need to sort of look at. Take a screenshot of that if you want to know. Shell, potentially good. Cisco. This is sort of the first filter. This is like the front line, and then, you know, once we start to find more, I'll go back to those ones that I put in this list and do more deep analysis. Net income. Cisco, pretty stable, not bad. I'm gonna give them a lower version though, because I know they're more of a cable-based company. Potentially obsolete technology. 8 billion. Average yearly income 4.1. Shares outstanding. Cisco stock 50.24. 3.9% coupon. Not undervalued. Under my standards. PDD Holdings is Chinese, right? Yeah, I'm gonna ask for a little bit more safety since it's from China. Okay, good growth. This quarterly. So I'm gonna look at the cash flow. Yeah, they had 3 deficit years between 2018 and 2020. When was their IPO? 2018. Wow. Sometimes it's a little risky to do an IPO that's only 5 years old. I'm going to price that in as well. I'm going to put this stock a little bit lower because of these deficit years, because of the recent IPO. I'm going to say it's about 4 billion annual. How many shares outstanding it is. The reason why I'm not doing 4 billion divided by the market cap is because the shares outstanding will give you a more diluted, more accurate picture. So 4 over 1.46 billion shares outstanding is 2.7 per share, divided by 144, 1.9%, not undervalued. Wells Fargo, WFC. It's funny, even after doing this for so long, you'll start to memorize the stock tickers and stock price charts. It's kind of a weird thing that happens. Wells Fargo has had some instability in the past. I'm going to conservatively evaluate them at, I'm going to give them a $3.5 billion quarterly earnings. If I compare that against their annual values, this is 14. Can I justify 14 billion? Yes. Yeah, 14 billion is around their dip here in 2022. I think that could be a good average earnings for them. Balance sheet, income statement, 3.7. 3.8 earnings per share, WFC stock, divided by 56. 6.7%. Yeah, I'm looking for something a little bit different than that. Something a little bit more yieldy than 6%, maybe even 8%, 7%. Those would be solid. 10% would be even better. Okay, pretty stable, pretty good growth. I can evaluate this a little bit less conservatively. I can say this is going to be about 2.2 billion times 4. 8.8 billion indicated. Yeah, that's a little bit high, actually. It's an exceptional year. It's not really, though, because they've had this past growth. I'm going to put it more at 7.5, though. So 7.5 divided by the shares outstanding, which is this number. 7.5 over 0.736 shares outstanding is 10.2 earned per share. XP stock is going to be 253. Excuse me, 4% yield. Unimpressive. VZ, let's go a little bit faster. And just follow along. Just give you guys a shout when I find something good. 10%. It's pretty good. I'm going to put that on the list. Yeah, I mean, this is very surface level stuff. Like, I'm not really thinking too much about the qualitative factors, mainly just looking at the cold numbers. This is one approach. I'm going to show you guys many different approaches to evaluating stocks. One of these days, I'll show you a more qualitative approach. Caterpillar the industry has experienced an exceptional year, so I'm going to bring their normal earnings to more like 2.25, which would give us 9. Yeah, I like that number. $17 earned per share. Divided by 343. 5.1% coupon. Not the best. Morgan Stanley. Also an industry-wide exceptional year. I'm going to place them at more about 2.2 billion, so 8 billion. 8 over 1.6 MS. It's about 5%. No. RY. I want to show you guys a quick example after I finish this page. This has had pretty good growth, slight reduction in the past, but I know Canada has experienced some economic difficulties. I'm going to give them an average of 2.4. 9.6. 9.6 is the normal earnings per year. About 1.4 rounded. RY stock. This is a foreign company. I'm going to ask for a little bit more. 4.3%. No. Sorry, Canada. Love ya. Pretty good stability in recent years, some deficits. I'm going to give them a 4 billion times 4. I'll give them 16 billion. Normal 16 over 2.4. Yes, that's the right stock. 4%? No. Yeah, especially if it's from France. No offense, French. Ooh. What is this? Does this mean they made no, or does this mean Macro Trends is having a problem? Yeah, it means they had a deficit. This is funny. Macro Trends may be acting up. Oh, it's probably because they don't have SEC published earnings. Okay, event. Want this. Okay, you guys may not be able to see this. No, you can. Profit before tax. I'm looking for net income. Basic net income. This is an example of a stock that is hard to understand. Okay. Okay, I'm gonna use this number, 50 billion. And then using their last year's number. So they made 34 billion last year. And they made 50.6 this year. Yeah, it looks like Macro Trends had some problems accounting. That means a 16.6 billion increase. Does this corroborate with what they say? 22 billion. Yeah. Plus 22. 38.6 current. Going back here. Sorry for the little delay on this one. Oh, they do have the annual values. And I was off. Oh, because this isn't report. This only reports to 12/31. Oh wait, this is first. What? Dude, their reporting there's something wrong with it. I was looking at 2023 the whole time. Wow, they haven't reported in 2024, that's why. Okay, I'm gonna use this. Their average is gonna be 15. Times 4 is 60. This is the nature of Chinese companies. Can't always trust their earnings. That's why I wanted to do my own diving, but I guess they don't want me to. 156. 9.8% coupon. You win. All right. Sorry. Goldman Sachs. Goldman Sachs says they're slightly unstable. So I have to look at their annual values. $8 billion, $8 billion. 7 billion looks like their lucky number. 28. Oh wait, no, 7 billion is their annual. 7 billion over $20 per share. Divided by 497 is 4%. Insufficient. Comcast, I'm gonna bet you a couple bucks that this may be undervalued. But for a reason, and we'll get to that. 3 point, we'll give them 3.5. 3.5 times 4 is 14. I'm going to corroborate that with their own posted cash flows. Yep. It's justified. Divided by 4.1 billion shares outstanding. It's 3.4 per share. A little misspell. 40. Wow, how did I know? 8.5%. I'm going to do one more, and then I'm going to do a little bit of explaining. India Bank. It's interesting. I haven't seen this one before. Again, this weird accounting error. Like, I don't know what's going on with that. I'm just gonna trust that these ones I'm going to save the deep analysis for later. I'm going to give him 1.5 times 4, 6. And then corroborate it real quick. 6 looks reasonable. Shares outstanding. $147. 1.7%. No bueno. Okay, so why is Comcast how did I know instantly that it was going to be undervalued? All right. This is where the qualitative comes in, because people believe that telecom services like Comcast are getting obsolete. There's another similar example with Paramount Global, who has major cable networks, and they own CBS. And if you look at their net income, you can see this is, very unstable. But if you take a look at their normal earnings, say you want to evaluate this at like 1 billion, which is low, then you would only give them a 7 PE ratio, 1 divided by 1 billion divided by 0.652 shares outstanding. It's 1.5 divided by the price per share, which is 10.94 currently. Let me make sure I'm right on that. Yes. That's a 14% earnings yield. So, someone who is just looking at the cold numbers would say, oh, that's an amazing investment. Well, you got to think about the qualitative aspects as well. The fact that this is so unstable, the fact that they have had slowing revenue growth, and they're in an industry that may be obsolete soon, are all reasons that maybe 14% actually isn't enough. Or it is. And so that's the problem with qualitatives, because they don't give you cold numbers to say, is this PE ratio or earnings, this is the earnings yield, is this earnings yield good enough or not? They won't tell you exactly. They'll give you just a broad picture. And now when we're looking at Comcast, it's sort of the same idea. Comcast has much larger standing than Paramount Global, so that already gives it a bump. Its revenue looks around the same. It's been stagnant for the past 2 years. It has experienced growth before then, though, so you can take that into account. But in general, the business that they're in has, potential risk involved, because a lot of it is TV based and people are pulling the plug on cable. You can see, they own Xfinity. They own some streaming services just like Paramount Global does, but a majority of the company's earnings do come from TV. And we've seen already a decline of like 40 million people switching over since 2010, something like that. And that explains why people have been selling their stock, pretty substantially. It's from its all-time high, it's down almost more than 30%. So I put that on the list as a learning example, but that's just something that you need to keep in mind, the qualitative aspects. All right, 30 minutes. Winner. AT&T is getting added to the list. Just like its friend Verizon. I'm gonna do this for another 10 minutes and then I'm gonna go into some of the other questions I had on the criteria list from before. Good growth. I'll give them 6.5. Wait, no, I did not mean to do that. 6.5 is their actual annual. .58. Sometimes it can be slow. 4.7%, not good. Okay. What's going on? It'd be helpful if they showed me some numbers here. Oh, wait. Yeah. It's because it's from Australia. Foreign companies are not macro trends' expertise. For foreign companies, you usually have to go into their official websites for their net income. The SEC is superior. There we go. Oh my gosh. Just give me a link that I can use. I know what the price of your stock is. Thank you. I just want normal financial results. I don't want a half year. Let's see if this is any good. No. Okay, let's go back to this one. Maybe this will be better. Do they even have an income statement? No. I wonder macro trends had a hard time. Okay, I'm going to save this one for later. I'll make a note. Canada. ConocoPhillips, pretty good. Give them the 2 billion, 8 billion. 8 over 1.2. COP. 6.1%. We can do better than that. A lot of this is relative. Like, it depends. On certain occasions, you would take a 6.1% stock. But since interest rates are so high and you can get risk-free rate for 5%, what are you doing taking 6% for a common stock? Pretty good growth. Elevance Health, it's interesting. I'll give him 5.5 annual value. Sorry. Okay. 5, 4, 3. No. Muff G. Kind of unstable. No, it's not bad actually. Give him 10 billion. 10 to 11. .4%. Not bad, boys and girls. I'm gonna make this a standing tutorial. You can see, right? Yeah. Curves. A little stretch. Citigroup. Citigroup is an interesting stock. I will show you in a second. Net income. A little bit unstable. Give him 11 billion. Financials 11 over 2. %. Not bad, Citigroup. Okay, so I wanted to show you something. Look at this. This is the max view of the stock price. It went from 1990 to, wow, 2000% to 2007, and then 2007 happened, the Great Recession, and then boom, 93%, minus 93%, and it stayed down here for years and years and years. There's a few examples like that's happened. KHC, Kraft Heinz Co. has happened too, where they had big growth and then boom, they dropped. In 2019, they've just stayed down there. What's another one I can think of? Tegna? Yeah, just boom, It's like a roller coaster. And then they recovered a little bit. Anyways. Alright. I'm going to do Sony and Chubb. Sony because they have cool products, and Chubb because Warren Buffett likes Chubb. And then I'll talk for a little bit and I'll wrap up. Financials, cash flow. It's not bad, 8.5 billion. And then that'll give us a per share net value of 7.1 and an earnings yield of 7.8%. I'm actually going to put them on the list for that. It's pretty impressive for a company like them. Chubb. Net income. Buffett has owned this stock. That's why I'm going to end off with it. $9 billion, $5 billion annual values. They have experienced growth, that's for sure. I'm actually going to see if I can derive a more accurate one from the quarterly earnings. This is about 2 times 4 is 8. I'll give them 8. Because it hasn't been that exceptional for the industry, at least I'm pretty sure. 8 over 0.414, and just out of, I'm going to check Progressive. It's a big, I'm just going to check a few of their competitors to see if they had exceptional years. They did. I'm going to check Allstate as well. They kind of did. Let's see. Are they undervalued at this potentially not conservative level? 7.1%. I'm going to put them on there. Just for Buffett. Alright. So we didn't make that much progress. Usually, when I'm not commentating, I'll just be buzzing through these real quick, and I have my calculator going, so the Google calculator, it doesn't slow me down as much, but this is the list that we have come up with, and I just analyzed 29 symbols and came up with 3, 4, 5, 6, 7, 8, 9 potentials. So I'm going to go through each of these, and I'm going to show you now the other criteria I use. So these gave us an idea of a good quarterly stable and yearly stable earnings, growth in those values. They're strong, seasoned businesses. They're very large. And the earnings and P ratios and earnings yields all look okay. The next question is it capital light? Does it have a good return on invested capital? So we're going to make little notes on each of these on TradingView right there on what their return on invested capital is. We're going to use their most up-to-date balance sheet values. So I'm going to set this to quarterly. I'm going to type in shell, shareholder equity, long-term debt, 187 plus 64. That will give us the total invested capital, $251 billion. And our net income number is going to be, I think I said around 25. Okay, that's 10%. 10% ROIC. That's what return on invested capital stands for. You see, I've put some notes on Verizon before. At one point, I had a position. $94, $138, $232 invested capital, cash flow. Gonna give them. They had some growth. This was a bad year for AT&T as well, which is their most comparable partner. Or no, it was not actually. Sorry, excuse me. I'll give them, knowing that, I'll give them 15. 15 divided by this. 6.4% returned on capital. It's less than Shell. All right, now we're going to look at HSBC. It's going to be averaging about 18. And wait, I just did quarterly for Verizon, correct? No, I didn't. But it looks like it's around the same thing, so we're good. In these, you can't get too caught up and too hung up on the exact values, because the whole point is you're making a big estimate and you're leaving a margin of safety, so you shouldn't have to be so precise. What is going on? HSBC 101 billion plus 198.6. Wait, 0.06. Making sure it's not a 60% ROIC, which is possible. Comcast. And this is important too, because it'll tell you, you know, how can this business bounce back in times of less liquidity, you know, higher interest rates, things like that. Because if they don't need a lot of money to run their business and make a bunch of money, then it should be okay if there's some harsh times coming, in theory. Yeah, I remember I said 11. Divided by answer equals 6% once again. This is making Ulta Beauty's 56% seem pretty good. I'm not gonna lie. That's one thing you get to know too, is, you know, as you analyze stocks and see what their figures are, you'll know what's good and what's not. I'm gonna give them 13. $119 plus $125. 5.3%. Okay, 3 and 4 more. MUFG. Got 9 minutes on the timer. 137 plus 308. Cash flow statement. Oh, yeah. Please. Yes. Okay. 10 billion. That's a 2, not a 22. There we go. Citigroup. Citigroup. Sorry. 11. Give them 11. Financials. Balance sheet. 206 plus 287 is 2.2%. Who knew financial companies barely have any return on capital? At least these don't. That was annual. I'm going to do that one more time. 209 plus 280. Slightly different. Again. Okay. Sony. I'm interested about Sony as well as Chubb. I wonder what they are. 52.1 and 14. 52 and 14 is 66. 66, and I said 8 if I don't. Yes, that's right. 8 divided by 56. 14%, that's the highest we've seen today. And the final one. This is going to be interesting because Buffett likes stocks that have capital-light businesses, so this may be higher than our normal peeps. Oh no, I probably did quarterly again. It's okay. It's okay. 65, 60, 78. And I did 8. I remember on this as well. 10%. Interesting. Well, we don't know the industry level. I mean, what's the industry? Let's see. What's the largest? I'll put in progressive. We're just doing a little benchmark here. Say 3 billion. It's going to be 3 billion over 30. That's 10% as well. So pretty on par with its friends. Nothing too out of the ordinary. All right. So I'm going to sit back down. Got 5 minutes left. We got these stocks, okay? And we looked at the earnings yields, and they're more impressive than the others. They're usually at least more than 7%. In today's interest rate, that's 2% higher than the risk-free rate, which is also known as the U.S. Treasury T-bill. You can look that up if you look up this effective interest rate, Fred. This will give you 5.3%. So that's what I'm using right now as the risk-free rate. Now, each of these we just looked at and got the, the capital light criteria, if it has a good return on invested capital. And the best ones that we found were Sony and Chubb. Sony at 10, Sony at 14, Chubb at 10. The rest, Citigroup and MUFG, were at 2. AT&T and Comcast were around 6. HSBC was around 6. VZ was around 6. And Shell was also higher at 10%. So that means they are a little bit better investments because they have 10% versus the other guys. Then the questions still stand. Do margins have room for improvement? Are they lower compared to the industry? We can easily find that out. Shell margins. Compare Shell with other stocks. I'm going to type in operating margin. And I'm going to put in, some major oil companies that I just know on the top of my head, I guess. Chevron. Okay. Shell, it's kind of had fluctuating up and down margins. No crazy growth. It's at the lower end for sure. I wouldn't expect that to improve too much, though. It's kind of been around here for a while, and it's very subject to oil prices, of course. So, since it's such a commodity-based stock, it may not have the same potential as assessing the other ones. So, I'm going to move on. Okay, T, it's the best one we got. Oh yeah, and T-Mus, what am I thinking? T-Mobile. It has had an increase in margins. T-Mobile's definitely higher, has had more growth, or no, it's around the same. Yeah, they're kind of all bunched up together right now. So the industry average is pretty industry average. It's pretty close to Verizon's margin. I'm going to look at HSBC. The reason why I'm kind of ignoring these is because they don't have such good operating margin growth. So, trying to assess if they're going to have growing operating margin growth is going to be an unlikely feat. Yeah, this one, same thing. It's had huge drop in margins. This is just one factor, and, by no means a deal breaker, but it is something you want to price into how much you are willing to pay for the stock. Falling prices, Paramount Global, Comcast competitors. I'm drawing a blank. Oh yeah, Disney. Charter. Okay. Charter has had growth. It's higher than the others. Comcast has experienced decline, but it does have some room for growth. Paramount Global has experienced great decline. Disney definitely has room to recover. But Comcast is already at a pretty high place and it's experienced decline. So I would probably count it against Comcast in this specific area. I'm just going to look at AT&T just as a reminder. Timer went off. It's okay, I'll finish up. Yeah, same story as Verizon. MUFG. I'm just going to make sure I know what the hell I'm doing. Financial services and bank. I'm going to do GS. Nope, not that one. GS. There we go. Definitely experienced some growth. It's very comparable. Don't see a lot of room for growth within the industry in their margin sector. Citigroup Has experienced some growth, definitely decline, but this is an industry-wide decline because of interest rates. This actually has some potential. Yeah. I mean, in Citigroup, about 120 billion. Yeah, I mean, it's definitely on the low end. Has some potential. Sony. I can think of Apple. I can think of Microsoft. What are some other competitors? LG. Do they have a stock price? Yeah. I'm actually just going to stick to Apple and Microsoft on this one. Okay, so Sony, growth, good to see. Definitely some potential for growth. I mean, Apple and Microsoft is very, very high margins. Yeah. Good outlook on Sony. I like them. Sony has capital light business relatively, and it has potentially good margin growth. Travelers. Definitely experienced growth. Liberty Mutual. AIG. Very up and down. This is a little bit difficult to see. Okay. Sony definitely had good margin outlook. And I'm also going to put that down for Citigroup. The rest of the guys were nothing to write home about. All right. The next things that we want to look at are shareholder-friendly management. Are they distributing value via dividends, brand growth, and repurchases? So, what are their dividends like? Shell, a yield of 3.8%. I'm going to write that down. That's the dividend yield. So, a dividend is just a cash amount paid out quarterly or yearly, or semi-annually, and what basically the yield tells you is the percentage of the stock price that is being paid out. So let's say it's $2 per share, and so the dividend yield of a dividend of $2 per share at $70 per share is a 2.8% yield. Kind of like what I was doing with the earnings. VZ, I know, has a pretty impressive yield. Yeah, 6.5. HSBC, 7.14%. Comcast, 3%. T, 5.7. MUFG, 1. Citigroup, 3.7. Oh. Whoops. Sony. See if we're gonna get impressed by Sony. No dividend. All right, and CB. 1.3. Trying to figure out why Buffett likes CB. So far, no dice. All right. So we have down how one way that they can expand shareholder value. I'm now going to look at a little more deeply. I'm going to look at their possible share repurchases. What I'm looking for is if there's a divergence between net income and share repurchases, but it seems like there's a slight one in recent years. Let's see. Again. Yeah, I don't. I'm gonna go to the SEC for this. Edgar. 20F is the name for their types of foreign reports. Okay. What I'm going to use instead is their financials. Looking for balance sheet. Repurchase of shares. This is in millions. This is kind of confusing. Purchase of shares 14. Oh, I see. So this is the number. 14 billion, 18 billion, 3.5 billion. Okay, so I'm going to say like the past 3 years they had an average of 14.6 plus 7.3 plus 3.5 divided by 3. $8.4 billion average repurchase amount. Okay, that'll tell us a little something. Because if you look at their total dividends paid and their cash flow statement, then you can see it's about 9 billion. So if you get an average of 8 billion, it's an increase of 15 billion per year, and on the market cap, 15 billion over 2. That's 6.7% return to investors. Not bad. Okay, I'm gonna look at. Oh, nice. Okay, Macro Trends does have this, except it's off by a lot. So I'm not gonna use them. Sometimes you want to use the most current 10Ks and 10Qs for these purposes. Just, this is a very surface level undervalued speed run, so this is about a few months old. I don't want to do that, actually. I'm going to go here. Statements of equity. Yeah, it seems like they don't do a lot of this. I mean, shares outstanding have been declining though. Oh wait, no, this is Shell. What am I doing? Yeah, they've stayed. They aren't repurchasing shares. Yeah. No repurchase is HSBC. This is a good way to just see. I could have been doing this before. You can see there's no repurchases, otherwise the shares outstanding would go down, and that means the average value per price would go up because there's less shares to go around. No repurchases. CMCSA, even though I'm not explicitly checking their financial statements, this is repurchase for sure. Now I'm gonna see how much in market value they are purchasing. Annual report. I'm going to find statements of equity. Okay. Stock repurchase program, there we go. 2023, 9.3, 10.9, and 4.1. 9.3, 10.9, 4.1, divided by 3, 8.1. 8.1, this is actually around the same. Share repurchase value average for last 3 years. Nice. The question is AT&T going to be like Verizon or not? It is. No repurchase. In fact, there's more shares outstanding. MUFG. Share repurchase. This is going to be a mess to figure out MUFGs. Oh wait, no it's not. Didn't they have a 20F? Yes, they do. Yes. Thank you, SEC. Thank you. Oh, I could have done that before. It's okay. Financial information. Click the wrong link. There we go. Just looking for... These are the notes. Where's the normal... There we go. These are all notes. Where are the repurchases? Where? I'm looking for value. There we go. Repurchase agreements are not the same as share repurchases. This is the repo that they're talking about. There we go. All right, share repurchase program. They decided to buy 225 million shares in 2022. Oh, wait, there we go. Nice. Okay, I can actually get an average of these shares. So 175, 419. And this is going to be in millions. So 819 million shares divided by 3, and then times the price. times 1050. 2.9 billion per year. Average share repurchases each year for the last 3 years. What did I say? That's what I said. 2.9 billion. Just for kicks, what is that? 2.9 divided by 128. 2.2% return to shareholders. All right, Citigroup, you're up next. Are you going to be good or bad? Good. Now the last one, are they investing into the brand? That's something that I'm going to save for a little later because it's more qualitative. I'll do some homework in between videos. There we go. Where are the repurchases? There we go. Average price per share. Yes, I understand. There we go. There we go. 2 billion shares. Yeah, this is a lot of repo. That's why shares has come up so many times. Repurchase agreements with the US government. Okay. I'm going to go back to where I saw. There we go. 2 billion, 3,250 plus 7,600 million divided by 3, average of 4.3 billion purchase per year. And this is common, right? Yes. Common stock times 61. Bam. Wow. Does that make sense? 260 billion in share repurchase? Does this make sense? 3.3 billion. It's like around 1 billion shares. Something's going on here. Oh, except per share amounts. Oh. Oh, this is in dollars. Okay. Okay. Yeah. 2 billion plus 3,250. This will give me $4.3 billion on average per year. Share repurchased on average for the last 3 years per year. I like how I'm putting it in different wordings each time, just to change it up. Now, is Sony going to return value to investors? Click. The answer is barely. For the past 3 years, they've done about 70 million shares outstanding. If I were to just get a quick idea of what that is, it's about 6.3 billion. Let's see. 20F. Where are your financial statements? There they are. Purchase of treasury stock. I'm looking for up-to-date numbers. I'm going to go back to their statements of equity. What does that cost? Yeah. Alright, it looks like $88, this is in yen, okay. That's alright, 88 million yen. It's 2021, okay. 88.6 plus 99.2. This is purchase of treasury stock. That's how they define it. And 203. And this is in yen, so gotta convert. Even though it'll be different currency conversions than the past 3 years, but 130. This is 130 billion. This is 900 million. Yeah, that's right. That makes sense. Because we did 6. Yeah. Okay. 900 million on average per year. Shares repurchased per year using last years. And finally, our favorite stock, or I should say Buffett's favorite. I guess I'm Buffett's analyst, so it's our favorite. Okay. It's pretty good. Chubb. I believe in you, Chubb. You're not a chump. I believe. Financial statements. Maybe I shouldn't have gone over the timer. Maybe I'm going a little crazy. It's okay. In millions of US dollars, so 2.5 plus 3 plus 4.9 divided by 3, 3.5 billion. That was in USD, right? Yes. Okay, using last 3 years. I'm gonna see something real quick. How much is that? It's about 3%. And how much was Sony's? Not impressive at all. Yeah, Sony doesn't really return value to its investors, even though it's a potentially undervalued company. Owning the stock is not going to be fun. This one was impressive, right? 8.4 over 223, 3.7%. I'm going to just quickly run through these. VZ, no repurchases. 8.1 billion. 8.1 over 155. So what I'm doing now is finding the yield of repurchases over the market cap. 6.9. Ooh, that's pretty good. Right. No, that's... I'm so dumb. 8 over 1... Okay, 5%. 5%. That was not right math. 2.9 billion. 2.9 over 128 is this. .1 over 117. 3.5, 4.3 actually, not 4.1. Gotta be exact here. 3.7%. Sony has 112. And what's 0.9 over 112? Not a lot, guys. Not a lot. Final one, CB. This was 3.5 over 1.9. 1.109. 110. 3.2%. 3.2%. Okay, so the most shareholder value that's returned, this is via dividends and repurchases, are CB and Shell and Comcast. And Comcast and Shell are by far the most. I'm going to check something real quick. Okay. All right. Now, I'm going to wrap this video up. I think it was pretty productive what we did. We found a few stocks that are potentially undervalued by the earnings yield. They're potentially undervalued in their growth and stability versus their price. Qualitative factors, we did not go over that much in this video, but this was more just showing you the ropes of, earnings yields, things like that, focusing on earnings to determine intrinsic value. We also definitely took a look at dividends and share repurchases and return on invested capital. We found some potential good ones. Comcast had a good return to shareholders with their high dividend and high repurchases. Same with Shell for the very reasons. But between Shell and Comcast, Shell had a very strong return on invested capital. So Shell might be a good investment. Let's see, the other ones. We had another one that was a good return on invested capital. It was... Yeah, it was Sony. Sony had 14%. Yeah, I mean Sony has good margin outlook and return on invested capital, but did not have a dividend, and it barely repurchased any shares. So if we wanted to see, if it had a friendly shareholder management, we'd want a big showing of their investment to grow the brand. So, and that's something I didn't go into quite enough today. So, to wrap it up, I hope you enjoyed that video. We went a little bit past the timer, and investing is something that is very time consuming, the way that I do it, the way that I believe that it should be done, but the risk and reward can be, very disproportionate to how much time you put in. I mean, it takes a long time to find one stock, but that one stock may be the only stock that you ever need to invest in ever again. That's what they say. So hopefully, in these videos, I'll find one that's very good. Right now, our best case is actually Shell. So there we go. Using these principles, that's what got us here, the Speedrun edition. And in the future, I will show more qualitative factors and talking about balance sheet and liquid asset values, and we got a lot to do. And I'm going to continue making these videos because, like I said, I want to show future employers that I know what I'm talking about, and I want to educate y'all. So I hope you enjoyed. Peace.